see, the mental framework of identifying stock has something in common.
So what is the framework that you guys used?
I think at SageOne, two things we really focus on is that there should be earnings growth in the companies that we choose, and we are buying those companies at a reasonable valuation.
And what are some red flags you look at?
Generally not well spoken, but selling your winners early.
I think this is something a lot of retail investors also have the same problem, that we make a system and then the stock price defies all odds, goes up to maybe 100p, and now we're all doubting that will this sustain or not.
Making a process, it's very important to have those bad cycles because only that will make you learn. Typically in a good cycle, everything is going up, so all your mistakes, get hidden. You don't come to know that you actually made a mistake.
What are those ting that comes in your checklist? Oh, I think this is peaking right now.
See, honestly,
Hey guys, welcome to today's podcast of Connecting the Dots. Now, in today's episode, I have got you two amazing fund managers from the fund SageOne. These guys are managing more than 8,500 crores in AUM and have been one of the flagship funds in the industry. So in today's video, we are asking the fund managers a lot of things with respect to how they pick stocks, what is their framework, what is their exit metrics, what is the portfolio management strategies, how do they evaluate a company, and a lot of other things as well. So the first guest of today is Mr. Satish. Now, Satish is a CFA charter holder and he has also done his MBA from Symbiosis and he did his bachelor's in commerce from Xavier's Kolkata. Now, he has been instrumental in the investment banking side. He has worked with ICICI Securities. He has worked with JP Morgan. He has worked on both the buy and sell side. And he has also been instrumental in working with family offices. Today, Satish Kothari basically manages the SageOne large and mid cap portfolio, and he is the senior vice president of SageOne Investment Managers. Now, the second guest for today is Mr. Kshitij. Now, he is also a CFA charter holder. He has studied via ICAI, and he also has a master's in commerce degree from Mumbai University. Now, he earlier was working as an equity analyst in Carnelian Capital, and he had worked across IT, pharma, and building materials. Prior to that, he also worked in Edelweiss for 5 years. Today, Kshitij is the vice president and the fund manager of the SageOne large and mid cap fund. So let's get into today's video and we are going to have some fun in this video. So stay tuned till the end. Kshitij and Satish, first of all, thank you for, giving some time and coming in. And SageOne is something that even I've been looking at for a very long period of time because your investment style and thesis is very different from what other people do, right? So first thing I want to understand, what is your belief of SageOne? Like, what is SageOne's belief? Like, what do you guys do at SageOne? And something about your fund that would be great for me to understand.
so SageOne was started by a gentleman called Samit Vartak. Samit comes with experience from after his post-graduation, he worked in US across consultancy and corporate. He had this knack of identifying businesses and investing in those. So when he came back to India for first 3-4 years, he did it for himself and his family. In 2012, he started SageOne. SageOne started in 2012 with the idea of identifying business and make superior returns in especially mid caps and small cap space. So he started with SageOne core portfolio. As things have moved, we have also evolved. Now SageOne has 3 funds: SageOne core portfolio, SageOne small cap portfolio, which was launched 6 years back, and with our latest offering, SageOne large and mid cap portfolio, which was started 2 years back. We offer all these 3 strategies across different structures in terms of PMS, AIF, and GIFT City structures. Today, we manage roughly around $1 billion, roughly around 8,000 odd crores across 3 portfolios. We have 3 offices: Pune, Mumbai, and GIFT City. And overall, we have an employee strength of 25 people. So the idea is to identify across market caps superior businesses which can deliver the desired return. We focus on long-term investing and concentrated way of investing, where we invest around 16 to 20 stocks across our portfolios.
Okay. Yeah. And this is for all your mid cap, large cap, small cap across the portfolio?
Yeah. So across the board, large cap has slightly higher number of stocks, but that also is around 20 to 25. So you can say 20 is the right, what we try to identify. We don't mirror any index, be it large cap or It's all bottoms up as an approach. Say at SageOne, we have the same lens whether we look at the large cap, mid cap, or small cap. Only the return expectation can be slightly different.
Got it. So a company is a company, and you go deeper into it,
Yeah,
basically.
yeah. So it's a research focused, totally research, bottoms up research driven approach which we follow across portfolios.
And what do you have core principles? Like, what are the core principles of SageOne?
Yeah, so I think the having a process is the most important. I think over the years, I think Samit has also formulated the process. Even we have individual process, and in that, I think a lot of people would look at common things like company management should be good, the business should have a moat, the ROI should be good, etc. But I think at SageOne, two things we really focus on is that there should be earnings growth in the companies that we choose, and we are buying those companies at a reasonable valuation. So for both of these, we even written notes ourselves, on what is the importance of having a process in investing. So we try to have that process and we stick through it even throughout, even though there are underperformances at some times. And why we have this approach of focusing on earnings growth. So we can take a very simple example, to understand that. So if you take any stock and you want to say make money over a 3 or 4 year period, there are two ways in which the stock price would go up or the value of the company would go up. One is that the earnings or the profits of the company or the cash flows of the company would increase, or the second is the valuations of the company would increase, which is the PE multiple. So we generally believe that as a framework, focusing on PE is very difficult because that is more linked to a lot of macro related issues or even flows, FIIs pumping money in, pumping money out, general sentiments, war, etc. So the P, can keep fluctuating up or down. It's a little more difficult to predict than earnings growth of a company. Earnings growth of a company is based to one particular company in an industry. You can, speak to a lot of people in and around, get some more sense. So it's just more easier. So that's why first we focus on the earnings growth, and then we decide we hope to buy it at a reasonable valuation. So if we do that, then the margin of safety generally, of the company is quite high, because if the company's earnings were say to double in a 3 or 4 year period, the P already automatically becomes half. So, that already gives one sense of safety. And secondly, if you're buying the company only at a reasonable valuation, the chance of that P becoming half is also, it may not happen. So most likely the company's earnings and therefore the share value should double. So this is the broad framework that we follow. And as Satish said, we follow it across, all the portfolios.
I would love to know your framework as well. But before that, first, let's go through your investment journey. Like, how did you reach where you are today, and what are the things you've learned over time?
It has been a long journey. So, see, I hail from Calcutta, typical Marwadi family. Father used to invest. So during that time, I think before my post graduation, I think used to see people that time the stock investment was whatever anyone says, right? You buy it, and there was no research, right? You listen to everyone and you buy everything. So, post my post graduation, I used to work with JP Morgan on their investment banking side. That gave me an insight into how the financing or the financial world or the financial markets work. 2006, I started my career, worked across Hong Kong, Australia, and unfortunately or fortunately at that time, that was the tough time for overall global financial market because 2008 global financial crisis happened. Suppose that I, being always passionate about equity markets, wanted to do something on the research side. So I moved to equities. I joined ICICI Securities and I used to work on their institutional research team. That experience gave me a lot of insights on how to go about the research, basics of the research, meeting companies, and a lot of insight because my clients used to be all mutual fund managers or on the buy side, the analysts on the mutual fund side. I think the questioning which they used to do. So it gave us a lot of insights, and there were a variety of views. There will be one bull side view, there will be one bear side view. So there was always that insight which came in. So that was quite a enriching experience in creating my fundamentals to understand the business. So post that, I started managing money for a family office. So that also gave a lot of insight because suddenly you moved from researching and then you became a stock picker, right? And there is a, although the basics remains the same, but there is a big difference when you
Manage portfolios, yeah.
manage someone else's money. And that experience taught me that stock picking is one thing. The other aspect of it is the risk management side as well, because when you are managing the money, I think that quotient of risk management is quite paramount, right? So that has helped me in shaping my investment career. A lot of I would say credit goes to the people who I have worked along with. Was fortunate enough to work whether from JP Morgan to ICICI Securities to Nuvama and then SageOne. One thing is there that after coming to SageOne as well, I think the learning which I have got in terms of doing less mistakes, how to look at certain things. See, investing is a journey. I think everyone learns something or the other at how much ever experienced you are. So as long as I am able to do that, it has definitely helped. As I said, from a stage where listening to everyone and buying everything to picking and choosing 20 to 25 best available stocks,
Yeah.
I have come a long way. And hopefully, I do know that I have a long way to go as well. Yeah,
But
so-
wow, that's very interesting because you've grown up around the markets and you've learned a lot through your journey in ICICI as well. And you were getting, would you also say there's a lot of information at that point? When you were at ICICI, were you across sectors or were you focused on like a particular?
Yeah, so we it was focused to particularly 2-3 sectors. So the journey was, so for example, in JP Morgan, I used to be a financial institutions banker. So I used to cover only financial institutions. So when I moved to ICICI Security, I used to cover telecom, media, and some consumer related mid caps, right, which have grown into a larger caps now. So obviously, I think after looking at financials, looking at these two, three sectors, I think I definitely learned how different businesses work. And then my experience of managing money for a family office really helped, because then you're not aligned to any sector and you're not aligned to any benchmark. For you, the entire market is open and you need to identify 20 to 25 best available stocks. So that has really helped. What I have gathered also, what I have gained also is that, see, the mental framework of identifying stock has something in common, right? That always remains. So that has become a part of my style. Now, at times it's very difficult to change your style, but over a typical any investor's journey, you try to gain more and more insights and add more and more value to your investing style. I do understand there will be periods of underperformance when you follow a particular style. I'm happy to gain those trades, be it, let's say, analyzing new age companies or analyzing new sectors, and come out better. So
Got it. But then I would really love to know the investment thesis that you guys have right now or the framework that you guys have at SageOne right now, because you've obviously seen a lot, learned a lot, and then you've come to SageOne, and then there is a thesis that you will also adapt and build, right? So what is the framework that you guys use to, what type of companies do you guys look at from a SageOne perspective?
Yeah, so I mean, as you mentioned, so earnings growth is the key criteria. So a lot of the normal things, as I told you, we look at the ROE and the company management, etc. So those we do look at, but definitely I think this is one of the key areas. So I mean, for this we definitely do put in a lot of effort, to figure out how that earnings growth will come. That is the main question. So whether that's talking to suppliers or talking to the customers, or in consumer companies just having going yourself, having feet on the street, and starting how things happen, etc. So I think it's a mixture of all these things. So once we get that conviction that okay, I mean this growth can happen, then we look at the valuation side and we see that okay, if it's at a reasonable valuation, then in most likelihood we wouldn't lose money. And if the company delivers on what we expect, it's also based on probability of these events happening. So of course you take those calls that what can be the industry growth and what can this company grow faster, can they gain market share. So you will take all those calls based on your research and then finally come to a conclusion, and based on maybe a probability that this is where it will likely be. And then I think when you construct a portfolio, it gets evened out, because now every company will not actually deliver on what you may think will happen. But if you have 20 companies, some companies will outperform what you think will happen. Some companies will underperform. Some companies may be there. So on the whole, if you pick a bunch of companies and meet the criteria and you don't go wrong too much, then and you don't make too many mistakes, then you should land up where what your objective was.
And do you have some like examples of how you found a company, built thesis on it, some convictions that you got, like the journey of what you just mentioned right now, in some example format?
Yeah, so I think just to add what he mentioned was that, see, at times India is a country where a lot of times there are different sectors which are at a different evolution stage and at a different growth level, right? So the idea is to identify companies which can grow significantly higher than the market, has a lot of runway of growth, and if it fits into our valuation criteria, we go ahead and invest those. So, and the ideas or the company or the filters what we use, as I highlighted that in a way, is that we look at a lot on the operating parameter side of the business. Uh, it's very easy to understand what is the P ratio, what is the ROE, ROC, and in today's world, it is readily available as
Correct.
well. And to give credit to today's investors, I think everyone is well aware of all these things. But for us, I think at SageOne, I think operating parameters going beyond the financial numbers, right? Investment success depends a lot on how your operating parameters move to financial parameters and then eventually price.
So you're talking about mainly margin
So
expansion.
when I am talking about, I will just try to explain operating parameters in a more. See, every company goes through a particular cycle, right? And it's not that every company will have the best of their times. There are things which company does, right, which eventually leads to market share gain, whether they are investing in new businesses or not, whether they are making their business less fragile. Let's say, for example, if the industry is not growing, you have to create that adjacencies to grow. So we like those kind of companies which has that non-linearity in terms of growth, right? And eventually, let's say, for example, there will be sectors and companies which, because of the industry structure challenges or because of the excessive competition, are not growing or are doing all things right in terms of operating parameters, but the financial parameters are not coming in because of the overall competition in the market, or because and perfect example is, let's say, for example, when we look at Bharti, right?
Bharti Airtel.
Bharti Airtel. I think for a long time there was no money made in the stock because there was excessive competition, there was high spectrum related payout, there were regulatory dues which they had to pay, right? But if when we look back at Bharti, they continue to focus on market share gain, they continue to gain subscribers, and despite very intense competition, they never let their operating metrics go down. When the cycle reversed, right, when there was a consolidation happened, because if you are one of the best in terms of operating parameters, you will be the last one to fall, right? There were others who fell. We saw so many telecom operators going shut their shop, right? And this guy only remained, right? When the cycle turned, they made the maximum amount of money, right? So, and if you look at the same framework and extrapolate it to, let's say, what has happened in airline space, right? At times, let's say, for example, Indigo. I think there has been instances where people have spoken about that airlines, it's very difficult to make money. But here there is an example where Indigo currently has market cap of upwards of 2 lakh crores.
Yeah,
Right.
yeah, it's
It will
quite
be reporting upwards of 10,000 crores of profit, right?
Wow.
So how many companies in India report that kind of profit? So the idea is that what they did well, I think if I have to ask you about the success of Indigo, everyone will say that they operate in a very, very efficient manner. Whether we like the airlines or not, that's a different matter, right? But they operate in a very efficient way. So it eventually led to they investing the same amount of money in expanding their fleet. And whenever there is any industry-wide turbulence, which we have seen in aviation a lot many times, I think the others exit out of the business and this guy is the eventual winner. right? So we try to identify those. See, another filter for us is, I think we invest in companies, and again we have written about it, that we look at companies which are capital efficient and at the same time has a long runway of growth. So we call it capital efficient and capital intensive at the same time. There will be many businesses in India which are capital efficient. I think a lot of FMCG, top rung FMCGs will be capital efficient, but size is a deterrent out there. Can I make significant non-linear return in those kind of companies? Answer is no. Until and unless there is some leg for growth. So we try to identify companies which can give us non-linearity in growth and are at the same time capital efficient as well. So the ability to plow back that efficiency to growth is the key to multi-bagger returns. That's what we feel. And most of the investments, what we try to do, we try to look at it from this lens across our portfolios. So that is one of bit of it. Maybe I think Kshitij, if you want to give an example.
I have a follow up on this. So, capital efficient and capital intensive, right? So, do you, because for someone to be capital efficient, there also has to be some capex involved, right? Like if the examples that you gave, whether it was Indigo or Airtel, they have done some amount of capex somewhere in the past. So, do you also track those cycles? Because the amount of capex depends a lot on the capital efficiency to come in. So, if it's too much, then it would take some time for that to. So, do you track that also? Like,
Yeah, so we track. So, for example, I think if you look at many of the retail players, right, there's a long runway of growth, right, across, and I think within the retail framework as well. I think whether you look at a value retailer or a QSR, I think India is at that stage, right, where the growth is whether it will happen in 5 years or whether it happens in 7 years, but there is a long runway of growth, right? So you know that there is a need of, you can invest, or the TAM, the audience, the size of the market is
it's
huge.
growing, yeah.
If you are capital efficient at the same time, whether you need that capex or not, your ability to succeed in that market goes up significantly. Your ability to invest in those kind of market goes up significantly, right? I think, and during COVID we have seen, right, trend. I think when all the retailers were shutting down their closing their store, there was one guy who was creating a new format, and right now that format is 800 stores. Yeah. So we look at companies which are at the same and doing it efficiently, right? Generating cash. Yeah. So and see, there will be times when it doesn't work for you. But as long as you are doing it better than the other peers in your industry, you will always stand to gain. That is what we focus on in terms of operating metrics. So we name it operating metrics, but it is like more of your market share gains, whether you're operating your store level economics are better or not. So those kind of things.
So here promoter also becomes very almost the biggest differentiator, I would say, right? Because there are promoters who are capital efficient by default. Like if the mention, like for example, Airtel and Indigo, they have been capital efficient for a very long period of time, whether it was in a bad cycle or even in a good cycle. So does management become a very crucial role? Like let's say all your metrics are good, right? But do you now drill down on the management and say, does this also fit into some kind of framework, which is not, let's say, fundamental or written down in some variables?
Yeah, I think definitely. So management also is important. So you take the same example, right? So in the same space of branded apparel, there have been two companies. There's been Trend and another one also that was equally large at that point, maybe 5 years ago. But in terms of the the way they deploy the capital, that company chose to go down the acquisition route. So they acquired a lot of multiple brands, took on a lot of debt for that. And because of that, the balance sheet got bloated. And then when COVID came, they had to make those interest payments, etc. And they found it very difficult to recoup all those gains. So in that sense, if there is a company with a very clear vision that, okay, even if we acquire something, maybe we are spending only a little amount for it, not too much of a balance sheet, so it doesn't put any stress. And we're doing it only because maybe it gets us 5 years ahead, 10 years ahead. And if we were to do the same thing ourselves, we would maybe find it difficult, have a lot of initial challenges. But to, overcome that or circumvent that, maybe we do a small acquisition, get some, ready-made platform, and then we can launch from there. So, finding those little qualitative attributes of managements, etc., I think it's very important. I think both of us also focus a lot on those, that what is the management's outlook, and how do they like to run the company. So if somebody is trying to take these outsized bets, or take those things that are difficult to predict, then it becomes very challenging for us, because as we mentioned earlier, that we focus a lot on whether the earnings growth will come and what is the probability of that happening. But if an event happens where we also can't predict, like when even say maybe Tata bought Jaguar Land Rover or some big asset outside India, it's difficult to predict what will happen in the long term. I mean, it may go right, it may go wrong. So in that sense, I think we like companies that don't take those very, or at least if they're taking it, at least we are able to predict, or we know that what will happen. But if we can't gauge what will happen, then I think we just prefer to stay away, because there are ample other companies in India that are very well run. So we try to stick to those managements where they take steps which are easy to predict, easy to know what will happen, and we know what the outcome will be in a few years.
And other thing, I think from what you guys mentioned, you also said non-linear growth, right? And from what I see, you guys also invest in companies where there are diversified revenue streams and not just coming from one single segment. Whether it was Indigo that started with airlines and now the food has slowly picked up, again, efficient in that process. Whether it's Airtel going into data centers and other businesses, slow but picking up over time, right? So do you also give weightage to companies that are have diversified or upcoming diversified revenue streams, or just single?
So I think the last question answers a lot on this aspect of it. I think a good management and a efficient management will always create that adjacencies in terms of creating new businesses, right? Whether investors are looking at the right lens or not. A promoter or a efficient manager will always be thinking 5 years down the line, where an investor, how much ever they want to focus beyond 5 years, but they will always be blurred with that what's the promoter vision or a management vision. So a lot of those things gets captured into in terms of management quality. It's very difficult to pinpoint in the sense that what these guys will do. But over a period of time, what we have realized is that good management, good promoters always create that optionality and non-linearity in terms of creating new avenues and new avenues of growth for yourself.
Wow. And would you say that it's difficult to find these opportunities in mid and small? Because large, though, we have a lot of data on the promoters also. But mid and small, thoda, it is difficult, right? Like for you guys, I mean, as a fund, is it like easier, difficult, or do you have some different approach to that?
So as I said, obviously the conception, the misconception is that you cannot identify those in mid and small cap. But see, just by the nature of market cap, in terms of sell side coverage as well, all these the larger companies are well covered. But for us, I think even if, let's say, for example, if you're looking at large caps or mid caps or small caps, the research level remains the same, right? And we look at the same lens. Given that there will be less literature or coverage around in the small cap, so you have to go an extra bit in terms of analyzing and looking at the growth drivers and all those things. But at the same time, if you go right, I think there is that non-linearity in terms of return also, which you can make. Because at times, as I said, that 100 becoming 200 although there will be opportunities exist for 100 to also becoming 200, but there are many smaller companies which presents you a significant opportunity where the growth can be upwards of 25-30% even in a bad environment as well.
Correct. So to just sum it up, so you look at, let's say, earnings growth, profit growth, operating metrics that translate into earnings growth, and what are the growth triggers that are there for these earnings growth as well. You look at capital efficient companies that have been capital efficient also for a long time, and that also talks about the DNA of the promoter. So by this, you have a very robust system and a robust framework. Now, can we look at something that maybe fit all of this but didn't work? Obviously, because there are so many things that don't work in life. Something that was a learning for you guys as well, or maybe something that you guys saw and you adapted to it in your fund.
Yeah, so at times it has happened. See, as I think investing is a journey, and you will always commit mistakes, I think, and we are not immune to that as well. We also commit mistakes. The idea for us is, as long as we are continue to focus on our process, whatever investment style or process what we have, there even after that there will be some mistakes which we do. So one of the common mistakes which particularly I have done is that at times I used to take management conviction as my own conviction. I think the bias kicks in terms of let's say if there is any turnaround, right? I think and there's no bad intention from a management or a promoter's perspective as well. The willingness to do the turnaround, the is there, but eventually it doesn't turn out because your competition move far ahead of you. The industry structure doesn't change. So those kind of mistakes we have done. Now I think the only thing which we look at is whether we can learn from those mistakes or not, right? So now we have moved more from management conviction to my own conviction. So numbers conviction, and at times, yeah, it will, right? I think the another common mistake what I used to do was that I think taking a challenger's profitability and looking at sector leaders' profitability and assume that this guy we can also reach there. But it's a common mistake which I used to do. I think sector's profitability is not a reflection of leaders' profitability. See, leaders generally, I think, and when I say leaders, not in terms of revenue market share, but in terms of, again, operating efficiency. I think they can be most efficient guys. They have a disproportionate share of the profit pool of the industry, right? So at times, I have failed on or mistakes. So now, broadly look at it from the perspective of whether a sector's profitability is a leader's profitability is here, right? And why is ahead? And by the time this guy wants to reach here, this guy can reach there, right? So that's always a challenge. So these are the key learnings. But eventually, what we have realized that the process is the key, right? The mistakes will happen as long as you hone your process, learn from your mistakes. You will become better. The other mistake, I think it's generally not well spoken, but selling your winners early. I think
this is very difficult to also.
Yeah, it's very difficult. So, but at times we have realized that. See, I think there are certain companies which grow much faster than the overall industry sector. And just because of the valuation or maybe one or two bad quarters, you tend to exit those names and you miss out. And it's very difficult to, again, buy back those kind of companies. So I think through proper research, why that has not happened or why the company is not able to perform for those particular times, I think you can try to mitigate those kind of things. So this is one of the key learnings. I don't know whether we'll be able to we will be committing these mistakes again or not, because as I said, I think in investing mistakes will continue to happen, but these are the common mistakes which I have done. Maybe Kshitij can talk about himself, but quite interesting. So yeah.
I think this is something a lot of retail investors also have the same problem, that we make a system and then the stock price defies all odds, goes up to maybe 100p. And now we're all doubting that will this sustain or not. And you tend to either take an exit, or the minute it falls down by 4-5%, all your long-term conviction is gone and you're out of the stock. This is something, even for retail investors, it happens because it goes outside your system. And it's very difficult at that point to be unbiased and say, let's book profit. And then it goes up another 50% and you're crying after that. So,
so art of selling is the
very difficult.
It's very difficult, and maybe I think we'll become better. And
but that's good. One question I have: why did you start the large and mid cap fund? I mean, what is the rationale behind the SageOne large mid cap?
Sure. So I think SageOne already, we had a mid cap fund, we had a small cap fund. And, we just felt that in the whole large cap space, if you see, there are very few PMSs that are present today. Mostly there are mutual funds that have large and mid cap funds or large cap funds. And we just analyzed those and what returns they're generating. And we saw that, on an average basis, most mutual funds are doing 1% alpha over the benchmark. So if we assume it's a large cap fund, maybe Nifty is the benchmark. If it's large and mid cap, maybe BSE 200 is the benchmark. So the alpha was 1, maybe 1.5, maybe maximum 2% on an average. So we just felt that, and if you see mutual funds as a structure, they typically have large AUMs. So they tend to hold 60 to 80 companies in the portfolio. So it's not a very concentrated portfolio. So we thought that, what if, we have an offering wherein we try to generate maybe 3 to 5% more alpha than the benchmarks. And, we do this by having a very concentrated portfolio, maybe only, 18 or 20 to 25 stocks. And also we focus a lot on the allocation of these stocks. So, certain stocks that we feel which will do really well, we allocate a disproportionate weight to those. So it is purely based on our conviction, purely based on bottoms up. It's not following any benchmark that if Nifty has say 32% banking weight, even we should have 32% banking weight. So nothing of that sort. For us, if we don't find ideas in banking, maybe we have only 5% weight. If we like banking a lot, it could be 50% weight. So there is no parameter to really, hug any particular index, etc. So we thought that by implementing all these things, can we generate that disproportionate alpha? So we started in 2022 April, and we started with proprietary money only, and we managed it for a year and a half. And throughout this year and a half, we kept discussing with the team on the approach and the whole process. And I think we've mentioned a lot on how process is very important to us. So we kept refining that, on so so I think 1.5 years for this particular fund was where we had kept having these discussions, on what is the optimal way to have this particular fund, and even when what is the return that we want to target, how many stocks do we want to own, how to run it, etc. So after 1.5 years, then we saw the performance. We went through a bad cycle. I think that's very important. Typically, when you're making a process, it's very important to have those bad cycles, because only that will make you learn. Typically, in a good cycle, everything is going up, so all your mistakes, get hidden. You don't come to know that you actually made a mistake. So we went through that bad cycle. We understood that, okay, maybe these few tweaks are there, but on the whole, the performance was still fine. So then I think in August 2023, we all had confidence that we were ready for launch, and we launched it. And now it's been almost 2 years that we've been running it. And I think so far, at least the performance, we've been satisfied. I think we've not changed much in the process, but yeah, we keep learning every day. I think that's what even Satish spoke about, that we also are going to make mistakes. Maybe we make new mistakes that we haven't made earlier, but we will make those. But at least the quantum of those mistakes should keep coming down. So earlier, if you made a very big mistake by say putting a large capital, large allocation to a stock, and went completely wrong, next time you would know that, okay, next time if you're not sure of something, then probably you have a little lower allocation or start off on a lower base and then add as you get more and more confidence. So small things like that, So we've made those tweaks, but on the whole, I mean, we are satisfied up till now, but we still keep learning every day.
Interesting. So I want to start getting into, I want to ask a question on portfolio management, if possible, right? So as you said, you allocate stocks in the portfolio and it's not equi-weight, it's different weighted. Now let's assume there's one bet that's gone well and it has bloated up in the portfolio and it has gone to maybe 25 or 35% of the portfolio. Now, according to all your process, it is a good company which is creating the levers of earning growth, right? How do you manage that? Because that happens in our portfolios also. Something becomes so big and now I'm worried that if that falls, my whole portfolio will go down. So usually what do you do? Like, is there a structure that you, or general structure that people should follow? Not maybe your fund, but a structure?
See, honestly, I think there are benefits of concentration as well. And if I would be wrong in saying that if there is a company which has done exceedingly well and there's a long runway of growth, you should exit, right? Even if it has become 20-25% of it. But when you manage a public money and when you manage your own portfolio, there is a slight difference, right? I think, as I said, I think mostly because I think risk management is kind of paramount. So if your risk management allows to keep that 20%, then you should have, given that you have the conviction in the stock. If your risk management doesn't allow, then you should trim it. I think and still maybe at the highest of the weight, but whatever that limit you set yourself, right, in terms of managing the risk, I think you should keep it at that level, because someday it can work. Someday, if it turns out to be bad, it cannot work as well. And as I said that stock picker and a fund manager is slightly different. A fund manager has to look at it from a risk management perspective as well.
Oh, okay. So you have an investing framework and you have a exit or risk management framework. That's not followed.
Yeah, which we follow at SageOne, that how to look at it has not happened that something has become 20-25% of our portfolio, but overall what we look at, I think we go as high as 10-11% in terms of allocation as well, because we are not buying significantly more stocks and all, even if 4 5 stocks, there will be outliers in a portfolio in a particular year. There will be 4 5 stocks for everyone, which will uh, lead the performance, and there will be one or two which will track. So, but eventually, I think it settles down at that level. But we look at it more from a risk management perspective rather than.
Got it. And what are some red flags you look at, like big no-nos in a company that it might look good, like, but what are the big no-nos?
Sure. So I think we typically do all the normal screeners are there, but we don't like companies where suppose the incremental ROC is say going to be lower. So the
Incremental ROC is lower.
lower.
Okay.
So today if the company is making say 20% ROC, but they are growing in the future. Say they are growing at maybe even 30%, but the ROC in the future may be only 10% or 5% because wherever they're investing the money, and as we even spoke about earlier, that that was a branded apparel company that invested in other avenues which maybe there was a little risk didn't take off.
Yeah.
So if something of that sort happens, wherein the incremental ROC falls of the company, so that is something you don't like.
So
And even
sales is going up, but the efficiency of the company
company is
starts
going
going
down.
down.
I think he also spoke a lot about capital efficiency.
Exactly.
Yeah, and maybe because of
it's-
the industry structure, may not be the company is still doing fine. But if there is, let's say, for example, even in a capital efficient market, if the supply side issue is quite bad in terms of there are a lot of competition which is coming in, right? Then, despite the capex, despite the efficiency of the company, you need to wait it out till the competition eases. I think this is what exactly, if you look at it, what happened in telecom. Yeah. So I'm saying that if I think all these things, let's say, was true in Bharti for in 2020, 2015 as well, but you started making money after 2018. So you have to wait it out the things will get evolved, right? So you look at whether so at that time, maybe I think his incremental ROC was also lower than what was desired. So that doesn't mean it's an investment then. But when your supply side, because I think a lot of it is demand and supply in terms of when you look at the sectors, right? I think if you're making super normal profit, there is bound to happen that supply will come in, right? The supply side will lead to some deterioration in the cycle. So whenever things normalizes, and the converse is also true, right? If there is an excessive competition, your return ratios are quite are diluted right now. But once the competition eases, things will improve. So then it becomes an investment thesis, right?
Yeah. So this is what I wanted to ask next. That let's say we're playing on earnings growth and ROC growth and capital efficiency growth. How do I know I've peaked? Like when do I know that, or what are those ting 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 that comes in your checklist? Oh, I think this is peaking right now because this looks off, or it's going off maybe in one quarter. Like how do I know?
Yeah, so obviously there are, and supply side is the perfect example of that. If there is a significant increase in the supply side, we have seen that in, let's say, for example, paints. Recently, what has happened? They used to make a level of ROE, ROC margins. Obviously, there's a big guy who came in, and the profitability of the sector obviously was muted for a couple of years. So this is one of the things what we definitely look at in terms of how whether they can sustain that return matrix what we look at. The other thing, obviously, when we look at the company is that how are the growth opportunities, are the grow, and if market share growth, or even if the sector growth, for example, I think there are companies which now beyond a point, I think if it's highly penetrated, it's very difficult, right? They will have bouts of positive performance, but structurally, I think the sector or the industry cannot grow beyond a point. So those are the things we tend to avoid, or we tend to look at it in terms of it can be tactical for a moment, but doesn't become structural. Obviously, and there are disruptions in today's market. Your business cycles have shrunk. I think it has become too short. So you tend to look at companies which are less prone to disruption. So those are the things what we look at, and I don't know whether it answered your point.
I'll sum it up. So basically, sector TAM and sector saturating, new entrants have come in, and that automatically will show it in the account statements where my operating margins will start falling from where it was. My ROCEs will start falling down, ROCE will start falling down. Maybe ROE slightly might get affected. I don't know. The debt will start going up and automatically everything starts adding up and you will see the decline.
Yeah,
Any
so-
other
Yeah,
metric
so
that...
again, I think if there's something which is prone to disruption, I think in today's environment, that is, let's say, for example, if you are in an industry where you are doing a low-end job, can it be replaced by AI? Right. I'm just so my ability to forecast the predictability of the revenues, what he mentioned earlier, right? What we look at in terms of predictability of growth and the predictability of earnings, that goes down. So that limits my ability to value that business appropriately.
Got it. And do you have like a growth range? Like I know some companies guide 100% also. There are some companies that guide 20-25%. And do you have like a mental model of range ki, or you're saying depends on all the other factors, 100 is also fine. Like how do you analyze? Like do you have some model there?
See, when we look at growth, I think India's nominal GDP grows at around 10-11%. I think not beyond that. When you are looking at investing world, it's more organized. So you can add 1% higher to here. It will be more this thing. So we look at companies which can grow at 1.5x nominal GDP, upwards of that. As I said, and there are non-linearity to it. I think there are companies which are doing well. If the opportunity size and the TAM is higher, if they are efficient, they continue to surpass your growth expectation, right? So when you identify a certain stock, I think most of the multi-baggers, I think for anyone, for example, I think 10 years, 20 years back, you would not have thought that the size of Titan would have become this, right? Was there growth? Answer is yes. But how it will pan out, you never know. So I think market has or the demand has its own way of outperforming in terms of
Very, very interesting.
Just to add to this,
Yeah.
so I don't think we have an upper limit of growth. I mean, we're happy if there's more growth, but I think at a lower limit for all our portfolios, we have a certain threshold that the growth shouldn't be below this particular level.
Correct.
So, like for our large cap companies, we look at 16 to 18% because that is also the return expectation.
Correct.
So we expect, and as we said, that we don't expect PE to materially change. So if the growth is that much, the portfolio compounding also should be that much. For a mid cap portfolio and the small cap portfolio, mid cap we look at 20 to 22% earnings growth. Small cap is 24-25%. So I think because of the size of the company, you can expect more of the company smaller because they definitely the base is small, so they can grow much faster. So I think we have a minimum base criteria. But on the upside, I mean, we are happy as long as the growth is coming without spoiling the balance sheet or ROE and the other parameters. If there's higher growth, that's never a problem.
And your fund is usually a long-term fund, very clearly, right? Do you also take cash calls, like cash calls as in plus cash, minus cash? Do you take that depending on some parameters, like on a broad level?
It's long only fund, so
Correct.
we can never go negative in the sense we cannot take leverage. I think if you are trying to hint at that.
I'm talking about your cash allocation in the portfolio.
So cash allocation generally it is in the range of roughly around at peak it is, I think the highest level of cash what we have maintained is 15%. That was during election uncertainty and all those things. Generally it is in the range of 5 to 7%. Ideally we are comfortable with that. I think we still see that there are opportunities available which can meet our criteria, so we are ready to invest in those kind of names. Yeah. In terms of allocation, because for any new money coming in, we may do a staggered allocation in terms of deployment for a particular whichever strategy they invest in. That is how. Otherwise, we don't see any reason that we know that we cannot time the market, right? Yeah. It's very difficult to time the market. So as long as our stocks present or give us those kind of opportunities, we are willing to invest in those.
Very interesting. Very interesting. Awesome. Now I need some simple answers, right? One good book that you would recommend for like retail investors to read.
Capital Returns by Edward Chancellor.
Wonderful book. Yes.
I think there's this book on Buffett, which is by Making of an American Capitalist by Roger Lawrence. I think that's a book that everyone should read. It's the entire journey of his.
Yeah.
And I think it gives a fair sense as to what he's done over the years and how his process came to be, etc. That's a good book. And I think Thinking Fast and Slow by Daniel Kahneman. That's also a very good book. Just to basically have your to control your mind, etc. And I think we not touched upon it, but behavioral
Psychology of
finance.
investing. Yeah.
Yeah,
It's very
behavioral
difficult.
finance is a very important part of investing because everything is just not finance based. So I think that's a good book.
Wow.
From,
So one last question. This is mainly for the audience. Now, obviously, you guys are a fund. You have a lot of members in the team, research analysts and all. But now, let's say I'm an individual guy, or you are today an individual guy. Yes. How do we now start finding good companies, or what am I doing wrong, or what should I focus on? If I'm an individual guy, I want to make good amount of returns. How do I do it?
See, for me, I think identifying your own style, I think that is key. And when you identify a style, just think about it where you are going right and whether you are going wrong. I think the common myth in investing generally is that there is a particular style which works. There's nothing like that. I think all the style works as long as you keep learning from your mistakes and do it in a disciplined manner. I think it may take slightly longer time, but eventually you will be able to identify, you will get that knack of identifying business, identify stocks which can give you desired level of return what you are hoping for. So and see, investing overall, it seems logical, it seems quite it is easy, but at the same time, if you are investing into direct equity for retail investor, it needs some amount of time initially, right? You have to understand businesses, nuances of how to look at things. At times, as we have discussed over last 1 hour, that at times market is not about PE ratios and ROE, ROC. There's a lot more to it. If you are doing that, if you are focusing on that and creating your own style, then this market is an amazing platform to create wealth, to identify stocks, and yeah, that's what I feel.
To have your own style, have your own system gives you an edge over.
Yes, and obviously keep learning. I think it's very difficult to say that you can from day one you will have a style, right? We all, I think we discussed about our investment journey. I think we all have learned through that process. Committing mistakes, as I said, I started with, I think, listening to everyone. I think now doing on my own, so analyzing on my own stocks. So I think every investor goes through that journey. Earlier the better. The good thing is that now there is too much platform like yours and
Also too
many
much
other-
noise now.
many others. I think you pick and choose what works for you.
Yeah.
As I said, that every style works, right? Every style works, and he mentioned about behavioral finance, right? Beyond the point, I think PE ratios and all those things you can learn, but understanding of the business and the scalability of that business is more on the behavioral finance aspect of it, how to react when others. Yeah, so these are the nuances which you need to build. I think that is key. I think maybe I've confused, but
No,
I think
absolutely
for
bang
a-
on.
and just to add just one more thing that I think for retail investors is very important to focus on compounding, and it's called the eighth wonder of the world. So I think it's spoken about very less, but I think it's extremely important that you don't go behind greed, don't try to make quick money in a short period of time. So if you stretch it out for a longer period of time, you'll see your money multiply by large amounts. You just take a simple example that if you can compound, let's say 25% per annum, in 10 years your money is 10x.
Yes.
In 20 years, people would think it would be 20x, but actually it's 100x.
100x, yeah.
In 30 years, it's 1000x. So that is the kind of growth you're talking about. So even if you bring that 25% down, say to 18, 19, or even 15%, the amount of money you can make over a 30-year period is extremely large. So start early, save more, do it diligently every month, keep building up your portfolio. Don't keep shifting between different fund managers or different stocks and tips, etc.
Correct.
Just keep it slow, have that process in place, have that discipline in place, have that behavioral finance, think long term, and I think everyone should make money over the long term. Yeah.
I think this was superb, yeah, because I think we got a lot of information today from everything, from where we went from thesis to conviction to examples to your investing framework to valuations to exit metrics, portfolio management. My God, this was superb. Again, I want to thank both of you because you guys have given a lot of time to understand and learn, and this all helps the retail investors understand, right? My main job is to get the brains of the fund managers as much as possible to the retail investors. So again, thank you, Kshitij. Thank you, Satish, for this.
Thank
I
you,
really
Shashank,
appreciate it.
and wish all of your viewers all the best in their investing journey.
Superb. So guys, I hope you enjoyed this video and I hope you liked this video. And if you did, please click on that subscribe button as well. And I will see you guys soon.